Hi, I'm Jarrad Brown. Thank you very much for tuning into our video today. I'm an Australian expat financial planner based in Singapore, looking after Australians all over the world. Every now and then on these videos, we'd love to have experts join us to share their tips, their insights, and some of the gotchas to watch out for, whether you're an Australian in Australia or elsewhere in the world. Today, I'm thrilled to have with us Aaron, chartered accountant, crypto tax expert, to share some tips with us. We're going to ask Aaron some questions on what Australians need to think about when they're moving back to Australia. So whether you're looking to start a business, you're looking at shares that you own, superannuation, we're going to cover off some of the need-to-know information. So I hope you get a lot out of the session. But Aaron, as a starting point, perhaps tell us a bit about yourself and what you do.
Yeah, cool. So my name is Aaron Vaz. I am a chartered accountant. I'm recently a chartered tax advisor with the Tax Institute as well. And I'm finishing a Masters of Tax as well. So very heavy tax focused. I run a firm in Perth. I have a wide range of clients, small businesses, medium business, and as Jarrad mentioned, I do have quite a large crypto contingent as well. That's, I guess, a brief description of what I do.
Fantastic. So look, we might dive right into the specifics. We know there's a number of areas Australians need to consider when they're moving back to Australia from wherever that may be, whether that's to stay, to retire, or to keep working. So if we think about, I guess, just general investments, whether it be shares, ETFs, managed funds, I guess even crypto, and they're moving into Australia, so now they're an Aussie tax resident, what do they need to think about around the ways that they own them, how tax is going to be treated going forward?
Yeah, no worries. So look, broadly, those types of assets, fall into the capital gains regime in Australia, and real simple, what that means is any profits you make on them are taxed at your marginal rate. If you do hold these assets for more than 12 months, you do get a 50% discount on that. But a lot of countries don't do that. But unfortunately, Australia, that's how it works. So really, if you are shifting into permanent residency into Australia, it's really important just to have a listing of what you own and what the market value is at that time of moving into Australia. From a structures point of view, there are many options that you can hold your investments in with Australia, which is probably a good time to consider when you're moving. Whether that's family trusts, companies in some scenarios, and to a lesser degree, but SMSFs for your self-managed super funds as well. The point that you get to is that it's probably a good time to just consider whether other options are going to be more beneficial for you.
Excellent. So that's something you'd suggest that people look at either before or very shortly after they've come back? Yeah. Excellent. So you mentioned there self-managed super or superannuation in general. For a lot of Australians living outside of Australia, they've not necessarily been contributing to super. So what should they be thinking about around salary sacrificing, employer contributions, I guess all of those moving pieces going forward?
Yeah, so look, again, real broadly in Australia, if you are employed by someone, there is super guarantee requirements. They have to contribute 10% of your salary into your chosen super fund. You have certain caps each year that you're allowed to put through. So depending on your age, it might be beneficial to maximize your contribution base. It's currently at 27,500. If you're on a salary of 100 grand, that means your employer's going to contribute 10. So there's still a differential there, which there is merit in salary sacrifice and super, which is essentially using your pre-tax dollars to put money into your super. Super funds in Australia are taxed at 15% when they're in your accumulation phase, and your marginal rate could be 30% if you're around the 100 grand mark. So there's instantly a 15% saving there. So there is merit in considering depending on what your life cycle you're up to, that salary sacrificing a super could be very beneficial.
Excellent. And if someone hasn't been contributing to their super fund for a little while, can they utilise those unused caps from previous years, or is that all gone?
No, you can. So they do update these rules quite regularly. So there are look-back provisions if you haven't contributed super. Again, everyone's circumstances are quite different, but in a real simple sense, there are ways that you can, if you do, come into a large lump sum of cash, for example, to go back and contribute and use up unused caps.
Okay, Excellent. So certainly something to
Yeah, it's definitely
be looked at. We know one of the, I guess, sort of common smacks in the face of reality for a lot of our clients moving back is just how high the tax rate is. So I guess some of these things could at least bring that down
definitely, yeah,
a little bit where possible. Now, I guess changing tack a little bit, a lot of, particularly Australian expats will have as part of their remuneration employee stock options, share plans, LTIs, STIs, all of these grants of employee stock. Now, if they're in Australia, does that then become taxable from a capital gains perspective going forward? How does that?
Yeah, so again, it will form their pool of investments that I guess you've got to consider at the time of residency changes. So, look, loosely in Australia, the way employee share schemes works is that there are two main taxing points: is when you actually receive the shares, and you get taxed on the ordinary value of those shares, and then again, there's a second taxing point when you actually sell the shares. You pay tax on any profit. So that's where the capital gains regime comes in, and really that's what's going to apply to shares that you own from prior employee share schemes from other countries once you become an Australian resident.
Okay. So I guess when people are negotiating their salary, if they're moving back with their employer, these are certainly some data points they're going to want to consider. I guess that could be a bit of a double whammy if they're getting taxed on the shares at their marginal rate and then capital gains. I think they're really going to want to give some thought to what that all looks like. Okay. Probably not the best of news for people, but I think a bit of a reality to think about. Now, we were discussing earlier a number of Australians who return will look to set up their own business, whatever that may be, a sole trader, opening a bed and breakfast. What are some of the things they need to think about, particularly if someone hasn't run their own business before, whether it's sort of set up, accounting? What does someone need to consider if they're starting on their own?
Yeah, so the main ones is are you going to be a sole trader or are you going to run under a company? That's probably the first decision to make. Look, there are a whole host of reasons why you would go for either, depending on the industry, what type of work you're doing. But that's probably step number one. Step number two is just your basic registrations. In Australia, you need an Australian business number and ABN. And if you are turning over more than $75,000 a year, you need to factor in GST, which is our VAT tax of a flat 10%. They're the two probably key things at the start to get ready. And then, the standard bookkeeping, quarterly compliance, those type of things will follow, but it's as a result of your bookkeeping and information. If you get those kind of structures set up, the compliance will take care of itself with all the softwares available nowadays.
Okay. Excellent. So, sort of extending that further, or I guess changing tax somewhat, what if somebody either already has a business elsewhere, in Singapore or another jurisdiction, whether it's their own or they're a shareholder and they're going to contract from Australia to that business? What does that look like from a tax perspective, or what could it look like? I guess it's a broad question.
So look, if you're an Australian resident and you're working for a foreign company, for example, you are taxed again or if you're contracting, for example, it is still ordinary marginal rate. So it's if you send an invoice for $5,000 a month, you're going to be paying tax on that $5,000. So it is crucial to just be aware that all the money you're receiving isn't necessarily all yours, and to put some aside for tax, because from the Australian perspective, all they care about is how much you're getting. Whatever the source is, it all kind of rolls up into one tax return, and that's what you're going to be paying your tax on. So it's just the style of invoicing might be a bit different depending on what the requirements are in the other country. But from an Australian perspective, the main thing to know is it's still taxable, and to do factor in tax, especially for contractors, because as an employee, generally you have your tax taken out for you. As a contractor, you have to manage it yourself.
Okay, so I guess as a contractor, there's a lot more sort of individual responsibility when it comes to a lot of that. So Aaron, I guess just touching on one final area that we know is a very common question amongst Australians all over the world. They've got a property in Australia that's maybe rented out, might have been their previous home. They've rented it out. They're looking to move into the property when they come back, or maybe keep it rented out. I guess broadly, what are some of the things that that they need to think about in that scenario?
Yeah. So look, the main part that one is keeping track of dates that, major changes happen. So the date that it became a rental, the date that, became your main residence. Because, in Australia, even though we do have quite a hard capital gains regime, your main residence is exempt. You can only ever have one main residence at a point in time. But, it's quite common for people to have a rental that becomes their main residence, that becomes a rental again. So, the way that works, it will be a portion for the period that it is a rental. So it is just crucial to get your dates right, because there are some other exemptions. If you temporarily move away for a little while, you might not be eligible for certain taxes. So it's just, look, as simple as it sounds, keeping track of dates is the number one thing, because it makes an accountant's life significantly easier when they're trying to work out how much tax you actually need to pay.
Okay. Perfect. I feel like that's probably one we could spend a lot of time talking about. Lots of different scenarios there. So rather than going down that rabbit hole, we might stop it there. I think that's been really, really helpful. So really appreciate your time and taking the time to share these tips with our audience. I guess if anyone has any questions, how do they reach out to you?
Yeah, look, the best one is probably email. I do have other social media accounts as well that, I check every once in a while. But yeah, email's probably the best way to get in touch.
Perfect. Look, really appreciate your time. Guys, thank you so much for tuning into our video today. I hope you've got a lot out of the session. I will pop Aaron's contact details in the notes. So if you do have any questions, please do feel free to reach out to him directly. If you have any comments and questions, please do feel free to leave them in the comments section. We'd love to hear from you. Please remember to subscribe. Thank you very much for tuning in, and I look forward to seeing you next time.